Let's get some more on the session on global markets overnight. Larry Shover, Chief Investment Officer at SFG Alternatives, joining us live from the CME Group in Chicago right now. Larry, great to see you there. Yeah, just, I guess, give us your views now that we've seen, the end of the month, the end of the quarter in the US there for the month losses. The Dow not faring too badly, just off 0.3%. And for the quarter, we saw gains for those major US indices.
Yeah, so there's just, today there's a lot of performance preservation. The market just had to take a rest. We saw that just from a few weeks ago, we had that artificial 25-point run up, and since that point, it's just been like a pinball machine every day. But overall, the market has done very well, and I think people are looking forward to the next, the third quarter earnings season coming the next few days or next few weeks. Combine that with ECB and jobs report to see where it goes. But right now, it seems like we're trapped in that range of 1950 to 1990 in the S&P.
Just on, I guess, the outlook, what's your view? Do equity markets in the US push higher into the end of the year? As you said, there's a lot of positive sentiment towards the next earnings season. But then on the other hand, consumer sentiment falling in September for the first time in 5 months in that data out.
Yeah, no, that's exactly right. And I think you just have to look at it in relative terms. Relative to a corporate credit or government bonds, the stock market is still the place to be right now. And it seems like consensus might be overshooting Fed fund rates and 10-year treasuries a year from now. And that said, I still think there's going to be a reaching out for yield, and with cyclical stocks especially. So I do believe 2025 at the end of this year is plausible, and I do believe the stock market will continue to rally next year. But again, it's going to be different, where the data is going to have to say so before we rally, as opposed to 2013 when the market rallied way before the data said so.
Just on to what we're getting out of Europe as well, because there seemed to be fresh speculation that we're going to get something from the ECB, some kind of big bazooka perhaps from them at the meeting this week, given that continued slowing in inflation in the Eurozone area.
Yeah, it's interesting, because I agree with you that it seems like something big is going to happen, but I'm not sure how. Asset purchases, the covered bond market in Europe is very small, and you have all the political complications of putting that together. And then how can you promote lending in Europe when there's still banks deleveraging? Just counterintuitive. And you talk about manufacturing inflation in a deflationary environment. I think they have their work cut out for them. The market seems very optimistic, but Draghi has mentioned in the past, and I believe this, that he is going to wait to see the success of the current programs before they start something else.
So, what do you think then? So we don't get anything this week? They wait for those measures, those existing measures to sort of work their way through? Or could there be more hints of, the other options on the table? Are those options even enough?
Yeah, I think he's going to reiterate what he said last month, and that is he's going to wait to see the long-term refinancing operations, how they are actually working out, and trying that again, monitoring it, but full well telling consensus, telling the market that all options are on the table and asset purchases definitely aren't out of the question, but I can't foresee that happening on Thursday.
Okay. In the meantime then, how are you viewing Europe? We saw, the DAX, the CAC up overnight. FTSE was down, but the euro at sort of 2-year lows against the greenback. So how are you viewing those asset classes in Europe?
Yeah, well, when you look at the European equity market, a lot of people are seeing value there clearly just from a valuation standpoint, and they're right. But as a conservative long-term equity investor, I'd prefer to wait to see somebody else make the first 10% on their profits. I'd like to see the momentum shift. I don't think Europe's as dark as most people think it is. I just think they have some big structural problems that have to turn themselves around, and they will. But these things will probably take much longer than most expect. So I would stay away from that equity market for now.
Okay. And just in the fixed income space, what are you doing?
Yeah, well, I still like U.S. high-yield corporate bonds. That makes a lot of sense. Anything with Europe right now, I think I'd clearly stay away with, because I still think the dollar still has some room to go down against the euro, especially, and the British pound cross against the euro. So I would stay away from that, look more towards the U.S. high yield. I think that's the place to be.
Okay, and just in terms of the big moves in commodities as well that we've been watching, I mean, oil in particular, seeing big falls overnight. Yeah. WTI down over 3%, Brent off over 2%, silver seeing some very big losses as well, as did copper. What do you think, I mean, of that commodity space, and where do we look for opportunities if there aren't?
Yeah, and so I know I'm I'm brushing, painting this with a broad brush, but I think the changes right now are more secular in nature than they are cyclical. We have to keep in mind that there's been massive supply overhangs in the commodities space currently. We're underestimating the strength of the U.S. dollar and what that's doing, and also structural changes in China. I mean, that's affected how much raw material they're importing, which is a lot more than refined. It's also affecting the bonded warehouse market. So we're just going through a lot of secular changes as opposed to cyclical. It's going to take a while for it to work itself out.
Hong Kong, the protests there, we keep watching those. Obviously, markets are closed for the Golden Week holidays from today. But, I mean, is that just sort of adding to the sort of cautious tone on markets?
Yeah, I think it would, and good grief, it's 4:30 in the morning in Hong Kong, as far as I can tell, and it is a holiday there, but it's a major financial capital, and it was, I guess, comforting to hear the Chinese government actually talk about it yesterday here in the U.S., at least I read in the paper today. But, boy, the amount of people that are protesting right now, it's a little bit unsettling, and I think it is affecting asset class volatility as we speak.